It's 9:58 a.m. Your screen is bright, the last 3 trades are green, your hands feel a little warm and your mug tastes like stale coffee, and your cursor hovers over size while the market breathes in. This is the micro scene you know too well, the one that quietly asks you to do more with less discipline. So today, we'll treat winning streaks like a structural risk and build a clear, measurable defense that can stop size creep before it becomes a financial habit. Start with 2 short definitions so we speak the same language. R is the unit of risk you accept on a trade, equal to the difference between entry and stop expressed in currency or percent, and cumulative delta is the net buying or selling pressure measured by signed volume, a raw read on who's trading with conviction. I'll use those terms and then sparingly rely on concrete triggers like 2 5-minute closes past VWAP with rising cumulative delta. The stakes are simple and steady. Small, repeated increases in position size after wins compound risk faster than skill improves edge, and a sequence of size drifts can neutralize a good process. This is not moralizing, it's math and human wiring. If you add 0.25 R more after each win across 10 wins, your expected exposure can exceed your capacity long before you notice. And that is the vulnerability winning streaks expose. The mechanism that causes the mistake is behavioral first and cognitive second. Intermittent reinforcement from those early wins rewires expectation. Reward sensitization uplifts confidence, and novelty plus variable outcomes convinces you the edge is hot. Neurologically, you receive a hit of dopamine and you correlate it with larger risk, not better filter usage. So your brain treats increased size as the reward, not the disciplined trade. That translates into concrete patterns. You start adding size without rechecking entry quality. You relax your checklist, you widen stops, and you skip cross-checks like session volume or cross-asset breadth. The compounding effect is simple. Size rises, your volatility of returns rises, and your drawdown depth becomes governed by your new, unstated sizing rule, not your original plan. So the playbook begins with a hard assumption. Your default is baseline sizing and predefined gates. Nothing above baseline runs without explicit, measurable permission. Define baseline as 1 R per unit and record it. If a trade meets your A setup criteria, then risk 1 R. If a trade is off plan but you still choose to trade, then limit risk to less than 0.25 R and don't average in. If you have 2 consecutive winning trades, then no size increase greater than 25% for the next 3 trades, unless a specific multi-factor escalation triggers. That escalation trigger must be concrete. For a scaled increase to 2R, you need 2 5-minute closes past VWAP with rising cumulative delta, session volume greater than 1.2 times baseline, and either sector breadth greater than 70% advancing, or a confirmed trendline break plus clean retest plus higher low on 5-minute. If those conditions do not exist, no size change. There, a rule that requires measurable things prevents ad hoc upping. Add a hard daily cap too. Your maximum allowed per trade after any winning streak is 1.5 times baseline, unless you've logged and reviewed the prior session's trades during pre-market and the review justifies a higher limit. That review has to be written and timestamped. Pre-trade, map 3 branches for every intended entry. Best case, worst case, most likely. Write them down in 5 words. If worst case exceeds your capacity, then don't trade. If best case looks thin or the most likely case is ambiguous, then sit out until your criteria match. Use concrete entry confirmations. Examples: 2 5-minute closes past VWAP with rising cumulative delta before adding size. 2 consecutive range breaks with session volume greater than 1.2 times baseline before committing a second unit. Or a trendline break plus retest plus higher low on 5-minute as a follow-through confirmation. Cross-asset confirmation can be optional but useful. ES plus sector breadth greater than 70% advancing in the same direction supports aggression. If your confirmation list lacks any of those, then refuse to increase size. Implement timers and gates to blunt impulsive increases. After a streak of 3 wins in a session, impose a 30-minute cooldown with no size increases and a forced journal entry that includes the tags #ASAP, #falsepose, off-plan, size break, and tilt. Log it. During that cooldown, you can review your recent entries, check cumulative delta and volume, and remap the 3 branches. After any off-plan size increase, apply a stricter cool-off. No live trading for the remainder of the session, or a minimum 24-hour pause, whichever you prefer, plus a mandatory review before you touch size again. Size caps are both relative and absolute. Relative: do not increase size by more than 25% per trade without meeting escalation triggers. Absolute: never exceed a day's max exposure equal to 4R total without supervisory sign-off from your own documented rules. You can choose different numeric caps depending on your account, but the point stands. Codify limits so your limbic system can't play games. Add simple mechanical enforcement. Use order ticket presets for baseline size and an off-plan micro size. If your platform allows, lock larger sizes behind an increase gate that asks you to type a short justification before permitting an order above baseline. If not, use a physical barrier. A second monitor requires you to walk over and press a key, or a mobile app confirmation. These are low-tech friction measures that create the necessary pause. The psychological calibration matters too. Build a 2-part mental routine to break the reinforcement loop. Part 1 is a short pause script. Wait, breathe, check size. If the trade lacks 2 5-minute closes past VWAP with rising cumulative delta, then keep baseline size. Part 2 is an accountability micro-ritual. Record the trade intent in your journal with 1 tag and 1 brief justification before sending the order. Use the tags consistently. Use #ASAP when the trade meets your core edge, #falsepose when alerts turned into trades without the full filter, #offplan when you traded outside rules, #sizebreak when you increased size above caps, and #tilt for trades driven by emotion. That tag system surfaces patterns faster than vague remorse. Put process metrics on the wall of your dashboard. Track rule compliance percentage, average R per trade, frequency of #sizebreak, and the ratio of baseline to off-plan trades. Prioritize compliance percent over P&L in nightly reviews until compliance stabilizes above 90% for a rolling 20-trade window. That realigns identity with process, not with outcomes. I'll give a time-stamped example, so this is an abstract. NQ, 10:17 a.m., midweek, 2 5-minute closes above VWAP, cumulative delta rising, session volume 1.35x baseline, entry.